I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Common Sense on Mutual Funds by John Bogle is a classic investment book that explores the world of mutual funds. The book is written in an easy-to-understand style and is perfect for both novice and experienced investors. It covers a wide range of topics, from the history of mutual funds to the benefits and drawbacks of investing in them. The book is divided into 4 parts. In the first part, Bogle explains the basics of investing in mutual funds. He discusses the different types of funds, such as index funds and actively managed funds, and explains their advantages and disadvantages. He also covers the importance of diversification and the role of fees in mutual fund investing. In the second part, Bogle explores the history of mutual funds and the evolution of the industry. He discusses the role of mutual funds in the financial markets and the impact they have had on investors over the years. He also touches on the scandals that have rocked the mutual fund industry and the regulations that have been put in place to protect investors. The third part of the book is devoted to the performance of mutual funds. Bogle looks at the long-term performance of both index funds and actively managed funds and compares them to other investment options, such as individual stocks and bonds. He also explores the role of risk in investing and how it affects mutual fund performance. Finally, in the fourth part of the book, Bogle offers practical advice for investors. He discusses the importance of setting realistic investment goals and creating a diversified portfolio. He also offers tips on how to choose the right mutual funds and how to avoid common investing mistakes. Overall, Common Sense on Mutual Funds is an invaluable resource for anyone looking to invest in mutual funds. Bogle's writing style is clear and concise, and he does an excellent job of breaking down complex investment concepts into easy-to-understand language. Whether you're a seasoned investor or just starting out, this book is a must-read. Mutual funds are a type of investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers who make investment decisions on behalf of the investors. One of the key benefits of investing in mutual funds is the diversification they offer. By investing in a mutual fund, investors gain exposure to a broad range of securities, which helps to spread investment risk. This is especially important for novice investors who may not have the time, knowledge, or resources to build a diversified portfolio on their own. Another advantage of mutual funds is that they are typically easy to buy and sell. Investors can purchase and redeem mutual fund shares on any business day, and the price of the fund is based on the net asset value, NAV, of the underlying securities. Overall, mutual funds are a popular investment option for investors looking to diversify their portfolios and benefit from professional management. However, it's important to be aware of the fees and expenses associated with mutual funds, as well as the performance track record of the fund and its manager. Investors should also consider their investment goals, risk tolerance, and time horizon when selecting mutual funds. Fees and expenses can have a significant impact on the long-term returns of mutual funds. When investors purchase mutual fund shares, they are typically charged a range of fees, including management fees, distribution fees, and administrative fees, among others. These fees are typically expressed as a percentage of the fund's assets under management. One key fee to be aware of is the expense ratio, which is the annual fee that a fund charges its investors to cover its operating expenses. These expenses can include management fees, administrative fees, and other costs associated with operating the fund. The expense ratio is expressed as a percentage of the fund's assets under management and is deducted from the fund's returns. Another fee to be aware of is the sales load or commission. This is a fee charged by some mutual funds when investors purchase or sell shares in the fund. The sales load can take the form of a front-end load, which is charged when shares are purchased, or a back-end load, which is charged when shares are sold. The impact of fees and expenses on mutual fund returns can be significant over the long term. For example, a mutual fund with an expense ratio of 1% may seem small, but over time, it can add up to a significant amount of money. Assuming an initial investment of $10,000 and an annual return of 8%, the difference between a fund with a 1% expense ratio and a fund with a 0.25% expense ratio over 30 years could be more than $40,000. Therefore, investors should carefully consider the fees and expenses associated with mutual funds when selecting investments. Investors should also compare the performance of funds with similar investment objectives and consider the long-term impact of fees on their returns. By doing so, investors can select mutual funds that offer a good balance between fees and performance. In Common Sense on Mutual Funds, John Bogle discusses the long-term performance of mutual funds, comparing index funds and actively managed funds, and how they stack up against other investment options, such as individual stocks and bonds. Index funds are mutual funds that track a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. These funds are designed to replicate the performance of the index they track and are generally considered to be a passive investment strategy. Index funds typically have lower fees and expenses compared to actively managed funds because they require less research and analysis. Actively managed funds, on the other hand, are mutual funds that are managed by professional fund managers who make investment decisions based on market research and analysis. These funds are designed to outperform their benchmark index and are considered to be an active investment strategy. Actively managed funds typically have higher fees and expenses compared to index funds because they require more research and analysis. Bogle argues that over the long term, index funds tend to outperform actively managed funds. This is due in part to the higher fees and expenses associated with actively managed funds, which can eat into returns over time. Additionally, research has shown that many fund managers are unable to consistently outperform their benchmark index over the long term. Bogle also discusses the role of risk in investing and how it affects mutual fund performance. He argues that investors should focus on managing investment risk by diversifying their portfolios and avoiding market timing and frequent trading. By doing so, investors can achieve a good balance between risk and return and increase the likelihood of achieving their investment goals over the long term. Overall, Bogle's analysis suggests that investors should focus on low-cost index funds and avoid trying to beat the market through active management or market timing. By doing so, investors can achieve a good balance between fees, risk, and returns, and increase the likelihood of achieving their investment goals over the long term. Point 4 in John Bogle's book Common Sense on Mutual Funds advises investors to focus on long-term returns and to ignore short-term market fluctuations. Bogle argues that trying to time the market or make short-term trades is a losing strategy because it is impossible to predict market movements with any degree of accuracy. Instead, he recommends that investors adopt a buy-and-hold strategy, which involves buying a diversified portfolio of low-cost index funds and holding onto them for the long term. Bogle's argument is based on the idea that the stock market is inherently unpredictable in the short term, but tends to trend upward over the long term. He cites historical data showing that the stock market has returned an average of around 10% per year over the past century, despite numerous short-term downturns and periods of volatility. Bogle also notes that short-term trading is highly inefficient because it involves frequent buying and selling of stocks, which incurs transaction costs and taxes that eat into returns. By contrast, a buy-and-hold strategy minimizes costs and taxes and allows investors to benefit from the compounding effect of long-term growth. In short, Bogle's advice in point 4 is to focus on the long term and avoid short-term market fluctuations. By adopting a buy-and-hold strategy and investing in low-cost index funds, investors can achieve solid long-term returns while minimizing costs and taxes. In Common Sense on Mutual Funds, John Bogle's fifth point is to keep costs low. Bogle asserts that investors should focus on minimizing expenses, including fund management fees and trading costs, because these expenses can erode investment returns over time. He argues that investors should prioritize low-cost index funds, which have lower fees than actively managed funds, and avoid high-cost funds that charge excessive fees. Bogle cites research showing that expense ratios are a strong predictor of mutual fund performance. Funds with lower expense ratios tend to outperform higher-cost funds, even after accounting for factors like investment style, fund size, and past performance. He also notes that high-cost funds tend to underperform due to the drag of management fees and other expenses. To keep costs low, Bogle recommends that investors choose low-cost index funds, which track a broad market index and have lower fees than actively managed funds. He also advises investors to avoid funds with front-end loads, back-end loads, or high expense ratios, and to focus on funds with low turnover rates, which minimize trading costs. Finally, Bogle emphasizes the importance of understanding the impact of fees and expenses on investment returns. He notes that even seemingly small differences in expense ratios can have a large effect on long-term returns, and that investors should carefully consider the impact of fees when choosing investments. In summary, Bogle's fifth point underscores the importance of keeping investment costs low. By choosing low-cost index funds and avoiding high-cost funds, investors can maximize their returns and minimize the negative impact of fees and expenses. In Common Sense on Mutual Funds, John Bogle's fifth point is to keep costs low. Bogle asserts that investors should focus on minimizing expenses, including fund management fees and trading costs, because these expenses can erode investment returns over time. He argues that investors should prioritize low-cost index funds, which have lower fees than actively managed funds, and avoid high-cost funds that charge excessive fees. Bogle cites research showing that expense ratios are a strong predictor of mutual fund performance. Funds with lower expense ratios tend to outperform higher-cost funds, even after accounting for factors like investment style, fund size, and past performance. He also notes that high-cost funds tend to underperform due to the drag of management fees and other expenses. To keep costs low, Bogle recommends that investors choose low-cost index funds, which track a broad market index and have lower fees than actively managed funds. He also advises investors to avoid funds with front-end loads, back-end loads, or high expense ratios, and to focus on funds with low turnover rates, which minimize trading costs. Finally, Bogle emphasizes the importance of understanding the impact of fees and expenses on investment returns. He notes that even seemingly small differences in expense ratios can have a large effect on long-term returns, and that investors should carefully consider the impact of fees when choosing investments. In summary, Bogle's fifth point underscores the importance of keeping investment costs low. By choosing low-cost index funds and avoiding high-cost funds, investors can maximize their returns and minimize the negative impact of fees and expenses. Point 6 in John Bogle's book Common Sense on Mutual Funds advises investors to diversify their portfolios. Bogle argues that diversification is one of the key principles of investing, as it helps to minimize risk and maximize returns. He recommends that investors build a diversified portfolio of stocks and bonds, and avoid the temptation to concentrate their investments in a handful of individual stocks or sectors. Bogle suggests that investors should aim for a balance between stocks and bonds that is appropriate for their risk tolerance and investment goals. He notes that stocks tend to offer higher returns over the long term, but also carry higher risk, while bonds provide lower returns, but are less risky. By diversifying across both asset classes, investors can balance the risk and return characteristics of their portfolio. Bogle also advises against chasing hot stocks or sectors, as this can lead to concentration risk and underperformance. Instead, he recommends that investors invest in a broad market index fund, which provides exposure to a wide range of stocks and sectors. He notes that index funds are a low-cost and efficient way to achieve diversification, as they track a broad market index and have low fees. Finally, Bogle emphasizes that diversification is not a one-time event, but an ongoing process. Investors should regularly review and rebalance their portfolios to maintain their desired asset allocation and adjust for changes in the market or their personal circumstances. In summary, Bogle's sixth point highlights the importance of diversification in investing. By building a diversified portfolio of stocks and bonds, and avoiding concentration risk, investors can minimize risk and maximize returns. Regular portfolio review and rebalancing is also essential for maintaining a well-diversified portfolio. In Common Sense on Mutual Funds, John Bogle's seventh point is to stay the course. Bogle argues that investors should adopt a long-term perspective and resist the temptation to react to short-term market fluctuations. He notes that market volatility is a natural and unavoidable part of investing, and that investors who try to time the market or make frequent trades are unlikely to achieve long-term success. Bogle emphasizes the importance of maintaining a disciplined investment strategy, even in the face of short-term volatility. He recommends that investors stick to their asset allocation plan, avoid making emotional decisions based on market movements, and avoid trying to predict the future direction of the market. Bogle cites historical data showing that the stock market has delivered solid long-term returns despite numerous short-term downturns and periods of volatility. He notes that investors who adopt a buy-and-hold strategy and resist the urge to make frequent trades are more likely to achieve long-term success. Bogle also emphasizes the importance of patience and perseverance in investing. He notes that successful investing is a marathon, not a sprint, and that investors should be prepared to weather short-term fluctuations and stay the course over the long term. Finally, Bogle recommends that investors seek the advice of a qualified financial advisor who can help them develop a disciplined investment strategy and provide guidance and support during periods of market volatility. In summary, Bogle's seventh point underscores the importance of staying the course and maintaining a disciplined investment strategy. By resisting the temptation to make emotional decisions based on short-term market movements, investors can achieve long-term success and maximize their returns. Point 8 in John Bogle's book Common Sense on Mutual Funds advises investors to recognize the role of luck in investing. Bogle argues that while skill is an important factor in investing success, luck also plays a significant role, and that investors should be aware of the impact of luck on their investments. Bogle cites research showing that while some investors are able to consistently beat the market through skill, the vast majority of investors are not. He notes that luck can play a significant role in short-term investment performance, and that investors who experience short-term success should be cautious about attributing this success solely to skill. Bogle also notes that investors can be impacted by a number of factors outside of their control, including changes in the market, the economy, and government policy. He advises investors to focus on the factors that they can control, such as their investment strategy, asset allocation, and expenses. To mitigate the impact of luck, Bogle recommends that investors adopt a long-term perspective and focus on their investment goals. He notes that by maintaining a disciplined investment strategy and minimizing expenses, investors can increase their chances of success over the long term. Finally, Bogle emphasizes the importance of humility and perspective in investing. He notes that even the most skilled investors can experience setbacks, and that investors should be prepared to learn from their mistakes and adapt their strategies over time. In summary, Bogle's eighth point underscores the role of luck in investing and encourages investors to adopt a long-term perspective and focus on the factors they can control. By maintaining a disciplined investment strategy, minimizing expenses, and staying humble, investors can increase their chances of long-term success. In Common Sense on Mutual Funds, John Bogle's ninth point is to recognize the relentless rules of humble arithmetic. Bogle argues that the math of investing is unforgiving and that investors need to be aware of the impact of expenses, taxes, and inflation on their returns. Bogle notes that while the stock market has delivered solid long-term returns, these returns can be significantly eroded by expenses, taxes, and inflation. He recommends that investors focus on minimizing expenses, including fund management fees and trading costs, and consider investing in tax-efficient vehicles like index funds or exchange-traded funds. Bogle also notes that inflation can have a significant impact on investment returns over the long term, eroding the purchasing power of investment returns. He advises investors to consider the impact of inflation when setting investment goals and to choose investments that have the potential to beat inflation over the long term. Finally, Bogle emphasizes the importance of realistic expectations in investing. He notes that investors who expect to achieve high returns with low risk are likely to be disappointed, and that investors should be prepared to accept some degree of risk in pursuit of higher returns. In summary, Bogle's ninth point highlights the importance of understanding the impact of expenses, taxes, and inflation on investment returns. By focusing on minimizing expenses, investing in tax-efficient vehicles, and considering the impact of inflation, investors can improve their chances of achieving long-term success. Realistic expectations and an acceptance of risk are also essential for successful investing. In Common Sense on Mutual Funds, John Bogle's 10th and final point is to recognize the value of simplicity. Bogle argues that many investors are drawn to complex investment products and strategies that promise high returns or sophisticated risk management, but that these products and strategies often fail to deliver on their promises. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.